All right, let's do a trade recap on the two trades that we had this past weekend over the Easter holiday weekend. On Friday, I gave out these two levels here. We were looking at this order block here as demand. This was in our extreme discount section of the range. And we had this supply order block in the extreme premium of the range. So we knew coming into the weekend that we had these two levels on our chart, both in a location that were high probability. We also, you can see our volume range profile here, and we have liquidity from these two almost equal highs that we were looking to SFP. So we wanted to come up and SFP these, also giving this order block inducement. So as we were coming up, you could see market structure did give us some nice structure. So we had a high, a low, you broke that high, you made a higher low for another higher high. So we see a tap 1, tap 2, tap 3, as well as taking this liquidity into the supply. So we have a Model 1 Wyckoff distribution. And let's go ahead and remove that. And you can see that we have a break of structure from here over. And as we have this bearish break of structure, we are now looking for our entry. So the bearish break of structure is giving our intention. So we have this range and we have the initiation away from the range, coming back into this previous range here to mitigate it for a continuation down. We also had this golden pocket hit right here. So we know that we like to enter in on the retest after that break in a golden zone, preferably the golden zone. Sometimes we only come back to the 0.5, but on this particular time, we actually saw a Model 2 Wyckoff distribution, giving us a bit more confluence on this trade. And we see here that we also had a 15-minute order block that was created from the last buy to sell out of the supply. So we have this blue order block, the Fibonacci retracement, as well as a Wyckoff Model 2 distribution. So at that point, we knew that we could enter here around the golden pocket, put our stop loss at the top of the order block, and then of course we target the supply, the last supply that we had in this range. So we could also see that we had a nice high volume node right here, and we had another nice high volume node right here. So you can also use those as a bit of confluence as well. But anywhere in this range would have been a nice take profit if you would have caught that whole entire move. That is around a 6R trade on that short. If you would have just aimed at the top of that order block, you still would have made a 5R trade on a very, very simple setup with tons of confluence in it. Now let's take a look. We can take these off our chart. Now let's take a look at this long situation. The long opportunity we had, again, it was an extreme discount of this range, and it was the last remaining supply that we had in this range. So we knew if it was going to hold, it was going to be right here. So as we come down to the 15-minute, we can see that we didn't really have any structure coming down into this. So we might have to drop down to a 10 or a 5. So we had a bit more structure on the 5. You can see we had a structure here and one there. We made that last low and then broke up from there. So that was your structure. and you can see the bearish break of structure right there. Sorry, the bullish break of structure. And then we have a range. We have the initiation out of that range, come back down to mitigate this range for the continuation. So there's a few different ways you could have caught this trade. You could have caught it right on that break of structure. Or if you would have waited, you could have seen that this had a order block creation with an imbalance that broke this market structure high. So we could have used that order block as our demand leading out of the range. So again, we come here and we see that, hey, we are retracing back into our demand. We can take a long from that area, put the stop underneath that block, and then come back and target these highs, which would have given you an 8.8 R. And that's just going towards these highs. As you can see, we blew through everything. So if you were watching this in real time, you would know that you wouldn't want to take a profit here because you have a massive bullish candle that wasn't stopping by any means. And if you would have taken, maybe just targeted this high here, would have had a 14R trade. And if you were able to keep in it, which you should have, because again, we had complete nothing but one time framing up. So a good target would have actually been this first daily. That would have been a 19.5 R trade. That is a massive trade. You could have taken that trade and just left the charts for the week or hell, even the month. Something else I also want to point out here. Let's go back to the 15, show it to you on the 15. Again, it's a very simple, same thing I keep going over and over and over again. We have a range. We have the initiation out of the range. And we come back down to mitigate this range for the continuation of that move. So that is RIMC. So we have the range, initiation, mitigation, continuation. So even just using something simple as RIMC, you could have caught a very, very nice trade here. And it would have looked like this if you would have pulled your range that we made coming out of that structure. We have our high, we have our low. You come back and tap right back into that range. So you would have put your orders in here and put your stop at the low of that range. And again, you target that daily. It would have been about a 6.5 R trade if you would have gotten in that from the RIMC. And that is it on those two trades. We can take this off the charts now as well as that. Everything has been mitigated. So we'll pick back up here a little bit later on to post up more trade opportunities for the days to come in this week.